Imagine holding a stock that yields almost 10% in dividends. That's the story of SPC Power, formerly Salcon Power, in 2024. Despite modest share price gains, SPC declared a whopping 1 peso per share in cash dividends last year, up from just 20 cents in 2023. At today's prices, that translates into roughly a double-digit yield. How can a Philippine power utility deliver such payouts? In this video, we'll unpack SPC's history, business model, and whether its rich dividends are sustainable. SPC Power Corporation is essentially an independent power producer and retailer in the Visayas Mindanao grid. It generates and sells electricity from several large plants and also holds stakes in distribution and retail units. For example, SPC owns and operates the 203.8 megawatts Naga coal plant in Cebu, in partnership with KEPCO, and several diesel-fired generators. The Panay Diesel Power Plant, 146.5 megawatts in Iloilo, and smaller diesel plants in Bohol and Mactan. Beyond generation, SPC also has business lines in distribution and retail. Its subsidiaries include Bohol Light, Malaya, Electric Utility in Palawan, and others. Since 2017, it was authorized to broker and market electricity to end users, essentially acting as a retailer. In short, SPC's model is old-school power. Build or acquire generating plants, sell capacity under power sales agreements, then pass the power on to utilities or customers. For example, its fleet can sell to cooperatives or even aggregate demand. The fuel mix is mostly fossil. The Naga plant uses clean coal technology, circulating fluidized bed, while the Visayas plants burn diesel. Because of this mix, SPC's profitability can swing with coal and oil prices. We'll talk later about how that factors into strategy. Financially, SPC has been doing well lately. In for year 2024, it earned about 3.03 billion pesos in revenues and 1.48 billion pesos in net income. That's roughly a 49% net margin, huge for a utilities firm. Earnings jumped about 26% from the prior year. In fact, consolidated net income climbed 26.7% to 1.48 billion pesos in 2024. On a per-share basis, that's about 87 cents earnings per share, which makes the stock look quite cheap. SPC trades around 7.8 to 9 times trailing earnings today. SPC's balance sheet is rock solid. Total assets are 11.8 billion pesos at year-end 2024, against only 624 million pesos of liabilities. In other words, SPC has virtually no debt. Debt equity is essentially zero. The cash pile is even larger than the debt. This conservative finances mean SPC generates lots of free cash flow. The company's cash flows were described as healthy in 2024. Even after generous dividends, it still has ample retained earnings. For example, 2024's retained earnings were 9.58 billion pesos. Key ratios reflect this strength. A high current ratio of approximately 11.5 times. Return on equity around 12 to 14%. And an enterprise value over EBITDA near 5.4 times. All this suggests SPC is profitable and undervalued. It has a trailing price-to-earnings ratio of approximately only 8.9 times and trades around its book value, which is around 1.1 times. In plain terms, the company earns much more than it pays out, unless you count dividends, and has very low leverage. Let's dive into dividends, SPC's main allure. Historically, SPC paid varying dividends. In 2020, it paid 80 centavos in total dividends, 40 cents mid-year and 40 cents year-end. In 2021, it paid a total of 1.55 pesos per share. But then SPC cut payouts. In 2022 and 2023, only paid 20 cents per share each year. In 2024, management restored a big dividend jump. They declared and paid 1 peso per share, 60 cents in early 2024 and 40 cents later. That chart would show the roller coaster. The 2024 payout of 1 peso essentially translates to an 11 to 12% cash yield at current prices. Even if stock prices move, that's clearly double-digit territory. However, note how uneven the history is. Dividends plunged in 22 to 23 before rebounding. This reflects SPC's policy of mostly paying out excess cash. In better years like 2021, 2024, they pay more. In leaner times, they conserve. What about payout ratio? Stock data shows SPC's 2024 dividend payout was actually over 100% of net income, roughly 115% payout ratio. In other words, they gave away more cash than they earned that year. This was partly funded by SPC's huge reserves and equity income from affiliates. Indeed, since SPC has little capex, it can channel profits out to shareholders instead of reinvesting. But can that last? Many analysts worry it can't. As one investor noted, SPC can pay large dividends because it is not investing for growth. Maintenance capex is very low. Its earnings will decline, and eventually the dividend. In short, the dividend is generous now, but ultimately depends on SPC's ability to keep generating cash. How is SPC priced relative to peers? With a trailing price-to-earnings ratio of roughly 8.9 times and a high book value, SPC trades at a big discount to larger Filipino utilities. For comparison, Manila Electric typically trades 13 times its earnings with only around 4 to 5% yield, half of SPC's. Other renewable or growth names, such as ASIN, have higher price-to-earnings ratio and lower yields. In the utility sector, SPC is viewed as a value and dividend play, not a growth stock. Put another way, SPC's enterprise value over EBITDA of 5.42 times and price-to-book value ratio of 1.14 times suggests market expects little growth or risks ahead. In fact, market data notes SPC's share count is stable at around 1.50 billion and a market cap around 12.95 billion pesos. SPC's enterprise value is only 8 billion pesos because of its large cash. Even on a cash flow basis, SPC's valuation is modest, price to free cash flow of around 19 times and price to operating cash flow of around 17 times. Some investors have calculated fair value in the 9 pesos range, meaning today's 8 to 9 pesos price is seen as a good price by income buyers. What lies ahead for SPC? The company itself says it is pivoting toward renewables. It has DOE permits for a 48-megawatt solar farm in Iloilo and is planning battery energy storage projects. Management reaffirms a goal of adding 500 megawatts of new capacity by 2029, largely through solar and battery energy storage system. This is a major shift. The aim is to diversify away from diesel and coal and support the grid as solar and wind grow. On the other hand, SPC's legacy plants remain diesel and coal. Diesel fuel prices are volatile. If oil spikes, generation costs rise. Also, its big coal plant, KSBC, uses clean technology, but coal remains under regulatory and environmental pressure. A risk often mentioned by investors is that SPC's capex is essentially flat. It's not aggressively expanding major new projects beyond those announced. As one forum commenter warned, SPC is a sunset company. It's rich in cash now, but not reinvesting for growth. If demand or prices fall, earnings could eventually decline. Finally, the Philippine power sector is evolving. SPC's plants have long-term contracts, take or pay with the government, which provide stability, but rule changes like open access or new regulation could affect margins. On the bright side, SPC's strong balance sheet gives it flexibility to weather fuel shocks or pursue joint ventures. Its move into solar and storage is prudent, but execution risk remains. Many mid-sized independent power producers overpromise on renewables. In summary, SPC faces the classic trade-off: stable cash flow today versus uncertain long-term growth. What do real investors say? On the Pinoy finance forums and social media, SPC is often discussed as a dividend play. For instance, one experienced investor noted that SPC's earnings largely come from its 40% stake in KEPCO SPC, the Cebu coal plant, and its share in McTan Electric. He pointed out that SPC receives about 1.3 billion peso in dividends from those affiliates each year, roughly 80 cents per SPC share. In other words, a big chunk of SPC's cash is from its associates, not its own diesel plants. However, many caution it's a double-edged sword. Another forum commentator bluntly put it, SPC can pay large dividends because it is not investing for growth. Earnings will decline and eventually the dividend. Others call it a sunset company and worry that high yield could be a value trap. In short, the sentiment is split. Income investors love the yield and free cash, but they know that growth is anemic. Some even suggest alternatives like SCC, mining sector, or GMA7, media sector, for similar yields with different outlooks. Yet, SPC's shareholder base seems sticky. Many who bought in 2017 at 5 to 6 pesos per share have held on for years, living off the dividends. One holder admitted SPC became 50% of their portfolio simply due to dividend reinvestment. They plan to lighten up only if price reaches around 13.50 pesos, based on dividend discount models. This kind of sentiment, loyal dividend chasers, is why SPC keeps paying out. It has identified a niche of shareholders who value steady income above all. So what's our final take? SPC is not a high-flying growth stock. Its sweet spot is the conservative dividend investor, someone who prioritizes current income over capital gains and who understands the risks. If you're seeking a stable, high-yield play in Philippine utilities and can stomach the coal and diesel exposure, SPC fits that profile. Its very low debt and history of generous payouts make it appealing for income-oriented portfolios. On the other hand, if you're an aggressive trader or growth investor, SPC may not excite you. The business isn't scaling rapidly, and future earnings depend on maintaining its existing plants and affiliates. Environmental conscious investors may also balk at its fossil fuel roots. In summary, SPC Power is best for long-term, dividend-focused investors comfortable with the status quo. You're basically saying, I want a reliable cash flow, around 8 to 10% yield, and I'm willing to hold through sector risks. For such investors, SPC can make sense. It has ample cash, minimal debt, and the potential to gradually add renewable projects. But remember the warning. Big payouts today could come at the expense of tomorrow's growth. That wraps up our deep dive on SPC Power. If you're considering SPC, keep an eye on energy policy changes and their renewable projects' progress. And as always, do your own research. If you enjoyed this deep dive, don't forget to like, share, and subscribe. Stay tuned for more investing content made for Filipinos. Thanks for watching.